In the silent undercurrents of the US financial system, a quiet battle is unfolding, a contest for the very rails on which future money will move. On one side, there's XRP, the digital asset created by Ripple Labs. Born from the private sector's ambition to move value across the globe in seconds with minimal cost. On the other, there's FedNow, pronounced FedNow, a government-backed instant payment service operated by the Federal Reserve itself. Two very different visions, two very different origins, but aimed at solving a similar problem: the painfully slow, outdated way money moves today. Picture this: in 2025, you can send a high-definition video from New York to Tokyo in under a second. You can message someone in Australia instantly. Yet, moving money from one bank account to another in the same country can still take hours, sometimes days. For businesses, those delays are more than an annoyance. They're a drag on cash flow, a hidden cost that slows down the entire economy. This inefficiency has been the Achilles heel of the US payment system for decades. XRP stepped into this gap with a promise: settlement in 3 to 5 seconds, no matter where in the world the sender and receiver are. The technology doesn't rely on traditional clearinghouses. It doesn't ask banks to wait until morning or hold until Monday. The ledger is always on, always ready. For international transactions, it's a game changer, replacing days of waiting with a few seconds of confirmation. Then comes FedNow, launched in July 2023. It's the US government's answer to instant domestic payments. It allows participating banks to send and receive funds 24/7, 365 days a year, in real time. No blockchain, no decentralization. Just a centrally managed system that fits neatly into the existing banking framework. One where the Federal Reserve sits firmly in control. On paper, they're solving different problems. XRP is built for cross-border payments, FedNow for domestic ones. But history teaches us that such lines rarely stay clear. Technology has a way of expanding its reach, and ambition has a way of redrawing boundaries. It's worth remembering that the US government has never been comfortable ceding control over the flow of money. In the 1800s, when private banknotes proliferated, Washington cracked down to standardize the dollar. In the 1930s, gold certificates, once redeemable for precious metal, were recalled to give the government more control over monetary policy. In each case, when private systems threatened public authority, the public system won. So the natural question arises: if XRP proves itself as the fastest, most efficient way to move value internationally, will the US embrace it or replace it? And here's where things get interesting, because there are signs that the answer might be more complicated than a simple yes or no. Insiders in both the fintech and banking worlds have suggested something few would say openly. FedNow could, in theory, adopt blockchain-inspired architecture in the future, even if it doesn't call it that. It could integrate technology from companies like Ripple without publicly branding it as XRP. Such a move would allow the government to benefit from private sector innovation while keeping full control over the network's rules, fees, and access. For investors, that possibility creates both hope and anxiety. Hope, because if XRP technology were adopted at a national level, it could legitimize Ripple's years of work. Anxiety, because if the government integrates the tech but sidelines the token, the value of XRP itself could stagnate. We are left with a suspenseful question: is the US building FedNow to compete with XRP, or to quietly prepare for a merger of ideas that could change the payment landscape forever? And if such a merger is coming, who will benefit: the pioneers who built the technology, or the institution that controls the money? To truly understand where this battle might lead, we have to go back to the origins of each system. Ripple Labs launched XRP in 2012, not as a clone of Bitcoin, but as a deliberate evolution. While Bitcoin's blockchain relies on miners competing to solve cryptographic puzzles, a process that is secure but slow and energy-intensive, XRP uses a consensus protocol. This design allows transactions to be confirmed in seconds and at a fraction of a cent in fees. More importantly, XRP was never just about individuals sending money to each other. Ripple's vision was to connect banks, payment providers, and remittance services worldwide into a seamless network, a kind of Internet of Value. At the time, global payments were dominated by SWIFT, a messaging system created in the 1970s that moves trillions of dollars daily. But DOS and T actually move money. Instead, it sends instructions between banks, and the actual settlement can take days. Ripple's pitch to financial institutions was simple. Why wait 3 days for a transfer when it can be done in 3 seconds? This message resonated especially in emerging markets, where slow settlement could mean missed opportunities and higher costs. Over the next few years, Ripple signed partnerships with banks in Japan, Saudi Arabia, and the UK, among others. However, in the United States, progress was slower. Part of the reason was cultural. US banks tend to be conservative when it comes to adopting new technologies. But the bigger obstacle was regulatory uncertainty. In late 2020, the US Securities and Exchange Commission (SEC) filed a lawsuit against Ripple, claiming XRP was sold as an unregistered security. This legal cloud froze many domestic partnerships and made US-based institutions hesitant to publicly align with Ripple. Despite this, outside the US, adoption continued to grow, and some countries even began exploring central bank digital currencies, CBDCs, using Ripple's technology. Meanwhile, in Washington, conversations were shifting. The Federal Reserve, aware that the US was falling behind countries like the UK, Australia, and Brazil in instant payments, began developing FedNow. It wasn't a blockchain, it wasn't a cryptocurrency. It was a centralized, government-run system built to upgrade domestic payment rails without overhauling the existing financial framework. When FedNow launched in July 2023, it was hailed as a milestone. Suddenly, banks could transfer money instantly, 24 hours a day, 7 days a week, without relying on intermediaries. For consumers, it meant faster payroll deposits, instant bill payments, and fewer delays in accessing funds. For small businesses, it promised quicker access to revenue, reducing reliance on credit to cover short-term expenses. Still, FedNow was, and is, domestic. It doesn't solve the challenges of cross-border payments, where currency conversion, regulatory compliance, and time zones complicate everything. That's where XRP still has the advantage. However, the line between domestic and international transactions is blurring. Large corporations operate across multiple countries. Freelancers work for clients halfway around the world. Supply chains stretch across continents. In this interconnected world, the domestic versus international distinction may not last. That's why some experts see FedNow as a stepping stone, a testing ground for technology, user adoption, and infrastructure that could later be expanded to global payments. And here's the point few are talking about: if the Federal Reserve ever decides to connect FedNow to an international settlement layer, it would need technology that's fast, scalable, and proven. In that moment, Ripple's XRP ledger becomes an obvious candidate. But here lies the paradox. If the government adopts the tech without using the XRP token, the network could thrive while the asset itself languishes. Conversely, if XRP is formally integrated into FedNow, it could send the token's value soaring. The outcome depends on a mix of technical decisions, political strategy, and legal outcomes. And while the legal battle between Ripple and the SEC continues to drag on, there's a quiet possibility that both sides, Ripple and the Federal Reserve, are watching each other closely, preparing for a moment when collaboration might be more beneficial than competition. The question is, will that moment come because of strategic vision, or because one side forces the other's hand? If we strip away the technical jargon, the heart of this battle is about control, not just control over money, but over the information money carries. In the digital era, every transaction is a data point where you are, what you buy, when you buy it, and even patterns that can predict what you might purchase next. When aggregated, this information becomes incredibly powerful. Whoever owns the payment rails owns the ability to see the entire financial bloodstream of a nation in real time. For the Federal Reserve, FedNow represents more than just faster payments. It's a window into the economy that's clearer and more immediate than any economic report or market survey. With every instant transfer recorded, the Fed could track the velocity of money, spot spending slowdowns, and detect potential crises before they escalate. In theory, it could adjust monetary policy with unprecedented precision. Ripple's XRP ledger offers a different balance. Transactions are recorded on a public ledger that anyone can view, ensuring transparency, but without necessarily revealing personal identities. This gives businesses and individuals a degree of privacy, while still allowing regulators to trace activity when needed. The ledger is borderless, operating the same way whether the payment is between two banks in Chicago or between a freelancer in India and a client in Canada. Now imagine these two systems colliding. FedNow's centralized, government-owned network integrated with XRP's decentralized global ledger. The synergy could create a payment ecosystem unlike anything the world has seen. Instant, global, and tightly regulated, but the political implications are enormous. Would the US government be comfortable sharing control, even partially, with a private company like Ripple? Or would it seek to absorb the technology outright, much like how certain innovations from private firms have historically been nationalized or heavily regulated? It's worth noting that this isn't just a US issue. China's digital yuan project is a clear example of a government-controlled digital payment system with global ambitions. The European Central Bank is exploring a digital euro. Dozens of central banks are experimenting with CBDCs in this global race. Speed matters, and the US can't afford to fall behind. That reality may push it toward solutions that are already working, like Ripple's network. Yet, there's a counterpoint. The more a payment system becomes centralized, the greater the concerns over surveillance and financial censorship. Some critics worry that with FedNow, the government could, in theory, freeze accounts instantly, monitor every transaction in real time, and even set conditions on how money can be spent. While these powers could be used to combat fraud or crime, they could also be abused, intentionally or not. That's why some argue that a hybrid system, one combining government oversight with decentralized transparency, might be the safest path forward. Ripple's technology could serve as that bridge, but again, the unresolved SEC case looms like a shadow. Until Ripple has regulatory clarity, any formal collaboration with the Federal Reserve would be politically risky. Behind the scenes, though, partnerships often begin informally, through pilot programs, private meetings, and technology trials that never make the news. If such conversations are happening, they could determine the future of both FedNow and XRP, and the world may not know until a sudden announcement changes everything overnight. To see how such a shift could happen, we need only look at history. Technological revolutions in finance have rarely been gradual. The introduction of credit cards in the 1950s seemed like a novelty at first. Then, within 2 decades, they became a cornerstone of consumer life. Online banking followed a similar trajectory. At first, people were hesitant to trust it. Today, it's hard to imagine a bank without a mobile app. If the Federal Reserve decided to integrate blockchain-inspired technology into FedNow, it could happen faster than most expect. The infrastructure is already in place. Instant payment capabilities, participating banks, and user familiarity. All that would be required is a secure, scalable, global settlement layer. And XRP's ledger fits that description perfectly. Some analysts believe the tipping point could come from the private sector. If a major US bank were to adopt Ripple's technology for cross-border settlements and demonstrate massive cost savings, it could pressure the Federal Reserve to follow suit to remain competitive. The irony is that the same regulatory uncertainty slowing Ripple's growth in the US could, once resolved, trigger an adoption wave. Meanwhile, Ripple isn't sitting still. Despite legal battles, it continues to expand globally. In Asia, where cross-border trade is immense, Ripple's network is gaining traction. In the Middle East, partnerships with financial institutions are helping to modernize remittance services. Every new corridor Ripple opens strengthens its position as a global player and makes it harder for FedNow to ignore. Yet, there's also the possibility of direct competition. If FedNow evolves to handle cross-border payments without using Ripple's network, it could marginalize XRP entirely in the US market. That would force Ripple to rely on international adoption, which, while still lucrative, might limit its potential valuation compared to a scenario where it's integrated into the US system. This is where the stakes for investors become crystal clear. The next few years will likely decide whether XRP becomes a central component of US payment infrastructure or remains an outsider, perhaps a dominant one globally, but still outside the American core. In this high-stakes chess game, every move matters. And both sides know that one strategic decision could determine who owns the future of money in America. When we strip away the technical layers, the market speculation, and the legal drama, what we're left with is a question as old as civilization. Who should control the flow of value? Governments, with their mandate to ensure stability and fairness, or innovators, with their drive to create faster, cheaper, and more efficient systems. The truth is, both have roles to play. Governments can provide trust and stability, but can also stifle innovation through overreach. Innovators can disrupt inefficiency, but can also create instability if left unchecked. The magic happens when these forces work together, each balancing the other's weaknesses. Whether FedNow and XRP end up as rivals or partners will depend on decisions made in boardrooms and government offices. Decisions most of us will never see, but the impact will ripple into our daily lives, shaping how we get paid, how we send money, and how much control we truly have over our own financial destiny. Perhaps the real question isn't which system will win, but will the future of money serve the people, or will the people serve the system? The answer is still being written.